Hey everyone, welcome back to our channel where we delve into the world of finance and investments. Today, we're going to talk about a topic that can make or break your financial future: investment decisions. Did you know that a staggering 80% of investors make common mistakes that lead to losses? Stick around to find out how you can avoid falling into the same traps. Making informed investment decisions is crucial for achieving financial success. It's not just about throwing money into the market and hoping for the best. It's about strategy, research, and smart choices. Investment decisions are a crucial aspect of financial planning. Making smarter choices can lead to bigger profits, while poor decisions can result in significant losses. When it comes to investing, there are a variety of options to consider. One common investment option is the stock market. Stocks represent ownership in a company, and their value can fluctuate based on a variety of factors, including the company's performance, market conditions, and economic trends. Investing in individual stocks can be risky, as the value of a single company can be volatile. However, investing in a diversified portfolio of stocks can help spread out risk and potentially lead to higher returns over time. Another popular investment option is real estate. Real estate can provide a steady stream of income through rental properties, as well as potential appreciation in property values over time. However, real estate investments also come with their own set of risks, including property maintenance costs, market fluctuations, and the potential for vacancies. Bonds are another common investment option. Bonds are debt securities issued by governments, municipalities, or corporations, and they pay a fixed rate of interest over a specified period of time. However, bond prices can still fluctuate based on interest rates and other market conditions. Mutual funds are another popular investment option for those looking to diversify their portfolios. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. This can help spread out risk and potentially lead to higher returns than investing in individual securities. However, mutual funds also come with fees and expenses that can eat into returns over time. Exchange-traded funds, ETFs, are similar to mutual funds, but they trade on stock exchanges like individual stocks. ETFs can provide investors with exposure to a diversified portfolio of securities, while also offering the flexibility of trading throughout the day. Like mutual funds, ETFs come with fees and expenses that can impact returns. When making investment decisions, it's important to consider your financial goals, risk tolerance, and time horizon. Different investments come with different levels of risk and potential returns, so it's important to choose investments that align with your individual financial situation. It's also important to diversify your portfolio to spread out risk and potentially increase returns over time. In addition to considering your financial goals and risk tolerance, it's also important to do your research before making investment decisions. By taking the time to educate yourself and make informed decisions, you can increase your chances of making smarter investment choices and achieving bigger profits in the long run. However, making smarter investment decisions involves a combination of thorough research, strategic planning, risk management, and continuous learning. Here's a comprehensive guide to help you make more informed choices for bigger profits. 1. Set clear investment goals. Define what you want to achieve with your investments. Short-term goals. Goals you want to achieve within a few years, e.g., saving for a down payment on a house. Long-term goals. Goals with a longer horizon, e.g., retirement savings. Risk tolerance. Understand your risk tolerance and how much volatility you can handle in your investment portfolio. 2. Educate yourself. Understanding the basics of investing is crucial. Read books and articles. There are many resources available that cover the fundamentals of investing. Take online courses. Platforms like Coursera, Udemy, and Khan Academy offer courses on investing and finance. Follow market news. Stay updated with financial news from reputable sources like Bloomberg, Reuters, and the Wall Street Journal. 3. Diversify your portfolio. Diversification reduces risk by spreading investments across various assets. Asset allocation. Spread your investments across different asset classes, stocks, bonds, real estate, etc. Geographical diversification. Invest in markets from different regions to mitigate local risks. Sector diversification. Invest in different sectors, technology, healthcare, consumer goods, etc., to avoid sector-specific risks. 4. Analyze investment opportunities. Conduct thorough research before making any investment. Fundamental analysis. Evaluate a company's financial health by analyzing its financial statements, management, market position, and growth potential. Technical analysis. Use historical market data and charts to identify patterns and trends that might indicate future performance. Qualitative analysis. Consider qualitative factors like industry trends, competitive advantages, and regulatory environment. Use investment strategies. Implementing well-known investment strategies can guide your decisions. Value investing. Look for undervalued stocks with strong fundamentals. Growth investing. Focus on companies with high growth potential. Income investing. Invest in assets that provide a steady income, such as dividend-paying stocks or bonds. 6. Manage risk. Risk management is crucial for protecting your investments. Stop-loss orders. Set stop-loss orders to automatically sell an investment when it reaches a certain price to limit losses. Risk-reward ratio. Assess the potential reward against the risk before making an investment. Insurance. Consider insurance products to protect against specific risks, e.g., property insurance for real estate investments. 7. Monitor and review your portfolio. Regularly, reviewing your investments helps you stay on track. Performance review. Periodically review the performance of your investments against your goals. Rebalance portfolio. Adjust your portfolio allocation to maintain your desired level of diversification and risk. Stay informed. Keep up with market trends and news that could impact your investments. 8. Seek professional advice. Consulting with a financial advisor can provide personalized guidance. Certified financial planners, CFPs. These professionals can help you create a comprehensive financial plan. Investment advisors. They can provide specific investment advice and manage your portfolio. Tax advisors. They can help you understand the tax implications of your investments and optimize your tax strategy. 9. Stay patient and disciplined. Investing requires patience and a long-term perspective. Avoid emotional decisions. Don't let emotions like fear or greed drive your investment decisions. Stick to your plan. Maintain discipline by sticking to your investment strategy and not reacting impulsively to market fluctuations. Think long-term. Focus on long-term growth rather than short-term gains. Ultimately, investment decisions are a personal choice that should be based on your individual financial situation and goals. By carefully considering your options, diversifying your portfolio, and staying informed, you can make smarter choices that have the potential to lead to bigger profits over time. If you found this video helpful, make sure to subscribe to our channel for more investment tips and insights. We'd love to hear about your own investment experiences, so feel free to share them in the comments below. Together, let's make smarter investment decisions for bigger profits. Thanks for watching.